So this is the financial planning section. We're going to talk about understanding investment risk, and we catalog these, that's not the index, these videos. So some of you might be just joining us on YouTube. And if you are, please hit the subscribe and like button. And so you'll get notifications, hit the notification button for upcoming videos. So risk obviously is paramount, and understanding your risk is vitally important. So in preparing for this webinar, I like to show you folks that aren't specific to professionals in what we do. So when I'm referencing a mutual fund or a stock position or something like that, and I'm going to do that today, and any references are not recommendation, they're just examples. But when I'm doing that, I typically like to find resources that you can access. When I'm looking at definitions, I like to use Investopedia, which anybody can access. When I'm looking up ticker symbols and showing you, I like to use MarketWatch, which anybody can access, right? When I was looking for a good risk analysis tool, I saw nothing out there. So now some of you might say, hey, there's this out there. And if you know of something, please send it to me, because I would like to have the resource. So I think I've told you I'm in the middle of a couple of things right now. One is writing a program that's going to be part of the Attleboro University website. And I'm looking for resources like that. And the other struggle I'm having is a direct-to-consumer financial planning tool. But this risk analysis tool I could not find. The other project is a book that goes along with the program. So got a lot going on here. But what I'm going to share with you and walk you through is the risk analysis tool that we use called Riskalyze, and it's widely used in the industry. I actually remember I started using it back in 2010. I think it was, and at the time it was still very new. And when I would call in with the question, it was I can't remember the fellow's name, but the guy who developed it. Now I don't know, he's off on his yacht somewhere, because it's a big program, and it works really well. That's why it's so successful and so widely used. So I'm going to share with you Riskalyze. If you're a client, you've seen this and you've gone through it, but if you're not, it's the tool that we use. And like I said, there's a lot of different risk assessment tools out there. Some of them are just a piece of paper and tell us what your risk tolerance is from 1 to 10. I don't think that's very effective. I have to tell you, as good as I think this questionnaire is, first of all, it's just a starting point. Second of all, it can change at any time, right? And we're going to talk about that a little bit. So let me stop my share here, and we're going to share this screen over here. So you're going to be seeing me look over here. And this is for Frank and Joanna Miller. So raise your hand for me if you can see Frank and Joanna Miller. All right, excellent. So not a real group. This is my Frank and Joanna Miller are based on an actual client, but they're my go-to sample folks. And I did a financial planning process talk with Frank and Joanna Miller some time ago, and I'm going to repeat that. It was back in 2020. I went through the notes just a few days ago. But Frank and Joanna Miller went through a risk analysis, and it's a questionnaire that I like the psychology of, and we don't have time to go through the questionnaire, but if you wanted to go through it yourself, just send me an email, I'll send you a link. It identifies what your risk tolerance is on a scale of 1 to 99. And I like it because it kind of has a speed limit sign. Everybody can kind of visualize that. But I also like the psychology about it, because what you'll see from Frank and Joanna Miller's risk number, they came in at a 40. It showed that they had $1.3 million at the time. That it showed their 6-month comfort zone. So that's over the next 6 months. What are you comfortable seeing in your portfolio? Now, everybody is total amount of investments. Everybody's comfortable with this, right? This upside, the 11.5. Yeah, give me all the upside. It's this here, right, that makes people upset. So and may derail you from your strategy. And that's really what these risk tools are about, right? What's it going to take to keep you on board and meet your objectives? So that's all well and good, plus 11.5 minus 6.9. But one thing I like that this tool does that most others don't is they give you the dollar amount. Well, that's a $90,000 drop in 6 months. How do you feel about that? Now, you might say, well, that's okay. Or you might say, wait a minute, I didn't think about that, right? I don't think that way, as far as percentage tied to the total amount. So that's really helpful. And that helps people kind of check in. So I hope that makes sense. So identifying that risk for an individual, for yourself, is very, very important. But again, it's just the starting point. So we're going to go through. So that's Frank and Joanne. That's where we start. Now, here's where they were. And let me say this risk number. So this was taken, you can see here, June 29th, 2021. So if they were clients, real clients, they would actually be due in June for a reassessment of this. So as part of our financial planning process, you redo the questionnaire. So then we would get an idea, well, if they come in this year, is it going to be higher or lower, and how they feel about risk? We really don't develop a portfolio based on this. Most investment strategists they'll say, okay, we're going to get you to a portfolio that is a 40. It may end up right around there, but we've got a much more evolved process than that. But it's important to know where we are. So if we took this same questionnaire and sent it out today to Frank and Joanna Miller, market's down nearly 5% last week. Bonds are down, what did I say, 12%, 13% for the year. Everything's just falling. Things aren't looking good. Inflation's going to be here with us for a while. I just said it might be a year and a half, 3 years, 5 years. Could their risk number be lower today than it was a year ago? It's likely it would. And that, frankly, that could change in a month, because you've got the market, you have the economy, and then you have an individual situation. What if suddenly, God forbid, Frank's diagnosed with something? Could that change his risk analysis? Of course it could. It has little to do with age, really. So these age-based or time-based portfolios, I think, are they're just generally in the wrong direction. If they're used within segmentation, they can be great. But when you just say, I want to retire in 5 years, so I'm going to pick a portfolio that ends me there in 5 years, that is usually not the way to do it. All right, so let's start with their risk number. We talked about their risk number. Now let's look at their portfolio. So here they came in at 40. Let's just assume we go through it. Frank and Joanna are the same this year. And then let's look at the portfolio that they came in with. And this is one of the things that we do. Please don't make me log in again. Yay. Okay. So this is 100% where these folks were. So this was 401k and an IRA, I think, if I'm remembering right. But they had really common holdings. So an S&P 500 or a Dow Jones Industrial Average, exchange traded funds. We talked about active versus passive a couple weeks ago, or last week, excuse me. A Vanguard long-term bond ETF again. So that when I look at this tells me this person is very fee sensitive, right? So that an index fund, another ETF, another ETF, another ETF. Very, very low fees. That's good. 0.17%. Dividends are around 2.85. That's fine. Potential annual return is 5.47. But you'll see here, look at this band over here. Now, if you remember, what was Frank and Joanna's comfort zone? It was a negative $90,000 over 6 months. And there's a lot of work to get done or to do to get to that number. And this is showing a negative $148,000. So I'm not necessarily saying that, whoa, we got to check this because this is a big difference, right? There's nearly $60,000 difference there. But, and their risk score is 40 and their portfolio score is 57. I might say we've got to bring this down. Our differential of acceptance would be about 5 points on either side. But they might say, you know what, that's fine. I know I answered the questions that way, but I'm okay with this. And that's okay too. Then we would look at, some stress tests. And this is where this tool gets really, really interesting and really good. But I'm going to show you some of the issues with it too. So it shows, well, what if if a 2013 bull market were to happen again, what would happen here? The current portfolio would be up $251,000, up 19%. That's good. Everybody wants that, right? Everybody wants the upside. Well, what if a bear market happened again? Just like 2008, what if the bear market happened again? It would be down $293,000. So negative 22%. So well above what they wanted. So again, they might look at this and say, well, you know what? I understand that I'm okay with that. That's starting to push my comfort zone. Or they might say, no way, I can't do that. I could do that in 2008. I can't do it now because I'm just entering or going into retirement. What if the financial crisis were to happen again? That portfolio is down $423,000. So if that happens in the beginning of retirement, that is typically, frankly, if this happens in the beginning of the retirement at $1.3 million, it's going to change their retirement. But this certainly is going to change their retirement. So good to know, right? Look at these diagnostics and know what's in your portfolio. So if an interest rate were to happen again, right, which is where we are. So here is that aggregate bond index. And this is where there's some flaws in this software because this is showing what could happen with rising interest rates, as we saw from May 1st, 2013 to September 5th, 2013. But we're already well past this, aren't we? Remember, bonds are down. This aggregate bond index, in fact, is down. What was that number? I'm gonna jump around in my notes here, but I'm gonna give you the exact number per last week. That was down almost 13%, 12.38%. So we've already surpassed that. Now this is looking forward 6 months, and you could say, well, does this count in the original drawdown, right? The original loss of 12.38. And the answer is no. It's just looking forward. So this is where you've got to have also the expertise and knowledge and experience to apply to this. So the U.S. core index, and because there's, because of the way they're invested, this would be up 3.21%. But again, that wouldn't be a positive growth in this environment. It would likely be down, let's say 8 or 9, maybe 10%. And then if the pandemic were to happen again, the current portfolio would be down 20%. So that's really where we still are. So I think these are good looks. Let's see if there is a question. Gerard, would moving away from a bond fund into individual bonds held to full maturity help mitigate the interest rate risks? So Gerard's is a good question, Gerard. Yes, you could hold individual bonds and you could hold them to maturity. So you could buy a 5-year bond and get whatever yield that's paying today, which is, I think, slightly higher actually than the 10-year, right? So that's part of the economic problem. And then you know that the value of that bond is going to be there and you're going to collect the interest along the way. Yeah, we could certainly do that. The problem is it's difficult to buy bonds these days. It used to be that I would do exactly that. I would buy individual bonds in portfolios instead of bond funds or exchange traded funds because of the risk of the movement of the funds and exchange traded funds. But what's happened is, first of all, the big the fund companies and the SMAs come in and buy them. But also the pricing is way off. So it's more difficult to buy the bonds today, but good question, Gerard. Okay, so that is, the stress test. There's also this great heat map that shows you what securities, right, positions in here are giving us the most swing, right? What gives us the most return. And this isn't always this way, but this one gives you the most potential return, but also the highest amount of risk. Coming in second here is the S&P 500. So no surprises there, right? But there can be surprises sometimes when you look at portfolios. And then if we look at the overview here, I thought this was really interesting, and this is part of what we built out for the financial plan. So remember, their risk was at a 40. They came in at a 57. If we just added principal protection, in this case, it was a fixed indexed annuity, no cost, just that allocation of 1/3, nothing else, but that allocation of 1/3 to to principal protection, drop them all the way down to a 38, well below where they are. Now, again, I wouldn't stop there. I would do the account segmentation. Account segmentation is designing a portfolio for every part of their life. So we have very conservative funds, including a lot of cash for the first 3 years. And then we make it more aggressive as we go out, because that gives us the ability to invest and have growth, which we're going to see. I'm not as worried about the stock market as I am the bond markets, as you've heard me say. So over time, stock market will recover. And maybe Jason Zweig is right that it's good time to buy into international stocks, not a recommendation. But, that can make a lot of sense in the longer run. If you know that that volatility is going to be 10, 13, 15, 20 years out, that works really, really well. So you got to kind of go the extra mile and make sure you're using your asset allocation, using your principal protection that shows you can see the value of that right here, and then using that account segmentation. That's what helps people get through these things. Okay, now I want to share with you. So that was Frank and Joanna Miller. So now let's take a look at this. So I took a look at some really common funds. So we have, and I built this out just for you folks, right? Risk analysis example. So there's no dollar amounts here. I just built in a potential model portfolio, made it really, really simple. The weightings mean nothing other than I wanted them to be in this order: 2025, 2030, 2040. This is not a recommendation or either way to buy or not buy Fidelity Freedom Funds or this Vanguard Core Bond Admiral shares. Just these are really common. These Fidelity Freedom Funds we see all the time. So I wanted to share with you what it looks like, because you might say, well, I heard what Mark said, so I retire in 3 years. So I'm going to put a portion of my money here in shorter term. And then 5 years later, I'm going to need this money. And then 10 years later, I'm going to need this money. And along the way, we're going to add in some core bond fund to help, add some value, stabilize or whatever. And we have a little bit of growth here. So you might think that's okay. And that might be if your risk is at a 62 and the funding works. This actually works where you have these positions. But let's dig in a little bit. So let's look at the Fidelity Freedom Fund 2025. This risk score, this is funds that you're going to need in just 5 years. This risk score might surprise you. It surprised me, in fact, when I looked at it. So that it comes up at a 63. Now, remember, one's the most conservative, 99 is the most aggressive. But you'll see that the S&P 500 risk score is only at a 76. So that's about as aggressive as it gets, right, on the US markets. So this surprised me at a 63, the 2025 fund. The Vanguard Core Bond Federal Admiral share shows a 28. Worst case scenario, it shows over 6 months at 3.56. But let's look at it. And again, you can pull these up on your own. This is from Vanguard's website, the Core Bond Admiral shares. Again, no recommendation either way. I love it because it's a low expense ratio, but is it really giving us the stability we want for our portfolio? So let's look at the return, negative 12.7%. Holy cow, how do you feel about that? How do you feel about if you put, the 60-40 portfolio, 60% of your retirement holdings, your entire nest egg for the rest of your life, into something like this, and it's down 12%. You weren't planning on that because most people don't realize that bonds can fall like that. And are interest rates likely to continue to go up that'll drive these prices down? Yes. So that was interesting to me. So even though a great tool like Riskalyze shows, well, okay, negative 3.56%, I can take that. You got to dig in more. All right, well, wait a minute. What are these year-to-date returns? Because what's going to happen when Riskalyze redoes or continues to update their rear view looking analyses, because that's all these future projections are based on. That fund is probably going to, or that category as a whole, is probably going to look much worse. So you can't just stop there at these sophisticated risk analysis tools. What about the rest of them? How about the Fidelity 2025 fund? So this is from Fidelity's website. You guys can see this as well. I just went in and searched Fidelity 2025 fund. So it's got an okay rating. And most of these, I'll tell you, most of these target-based funds are simply okay. Higher expenses, 0.62. But, year to date, negative 17%. These are monies you're going to need in the next 20 or 5 years, and you're down 17%. Year over year, it's down nearly 15%. Not good planning in my point of view. I'll tell you that 100%. What about the 2030? Well, here's your 2030 fund. That looks very similar, doesn't it? Down a bit. And this is one of the problems too, is that they're invested very similarly. They just ratchet it a little bit. So when their holdings drop significantly, they all kind of drop. You know, there's a little bit of difference between the 2030 fund and the 2025 fund, but not a whole lot, is there? So still, when you talk about the drop in your portfolio value is pretty significant. And then the 2040 fund, negative 19%. Now, remember, let's look at what this risk tool, this really great risk tool, and I'm not picking on it, what they said about the 2040 fund. Worst case, negative 16%. They're much closer with that, aren't they? So that's let's go to 2040. They're 19.6. So I think that even with a great tool like Riskalyze, it's really not showing the true nature. Look how these all roll. 68 score, 63 score, 2030 and 2025. This is the most shocking one. And this one was closer, wasn't it? As far as the worst case scenario, as was the 2025 fund. But this one here, the Vanguard bond fund, way off base, way off base. So you'll see that you can't just rely on one thing. It's like, you know, going back to Social Security planning for a second. You know, I was having a discussion with Heather a couple of days ago, and we were agreeing that, you know, we were talking about the tools and what tools are the best and what she uses and what I use. And, you know, is there a better way? You know, what's the best out there? And she said, you know, they all kind of give the same output. But it's then, and most people, whether it's, you know, individual investors like yourself or you know, other financial advisors, most people just hand them that report and say, this is what you should do. This is how you should collect your Social Security. But you also have to factor in cash flow. You have to factor in taxes. And you have to do all that with your investments too. So I hope this was helpful as far as identifying what your risk tolerance is. If I wish you could just find a tool like this and use it. If you want to see what your risk number is and start there. If we put in your funds, we'd have to spend a lot of time putting your funds in. We can talk about what that looks like. But if you want to just identify your risk score, I'll send you the link. Just send me an email. I'll send you the link. And if you're watching this on YouTube, we're actually going to put the link in the YouTube description, so you can go in and do your own analyses or your own questionnaire. So you should know your risks, know what you're invested in, know your comfort zone, have a plan, and of course, review and adjust it. And the best way that I found to manage this type of volatility, I'll just say it again, asset allocation, principal protection, and account segmentation. You saw the value of principal protection right here. I think that is, you know, this is one of those things. It's just like being tax efficient. When I do before and after comparisons for people, and I show that just by doing something a little bit differently, you can be tax efficient and you'll have millions of dollars more at the end of your life, or it'll get you through to your end of your life potentially, where you had serious risk about it. You know, if you continued to be in tax deferred and being tax inefficient. So making small adjustments can be life-changing. What I want to point out here before we move on, I think I'm still sharing, is not only did we reduce the risk score, and I didn't mention this before, but we went from a 57 to a 38, which is really a big drop. The potential return, annual return on the portfolio actually went up. So, and we see that. So the individual annual dividend went down because part of it is in now a fixed indexed annuity. It doesn't have a dividend. It's principal protected, it's tied to an index, no dividends though. But the expense ratio, even this is very low, 0.17%, came down as well. So we reduce expenses, reduce risk, and increase potential returns. That's beautiful. And that's a real world example. So again, have a plan, review and adjust, know your risk, know your comfort zone. I hope that was helpful. We will see you next week. If you're on the class schedule, we'll see you tonight. We'll see you Thursday. Have a great week. If you have any questions or comments, if you want to do your own questionnaire, send me an email. I'll be happy to help you. Have a great week, everybody. Take care.